You know that one friend, the one who casually mentions they just made $200 this month, literally without lifting a single finger? Or maybe it's that neighbor who's always just sipping coffee on a Tuesday morning while you're rushing to work. It's maddening, right? It almost makes you feel like they've got some secret money tree hidden in the backyard. Well, spoiler alert, they don't. But what they do have is a system. And today, in this explainer, we're going to break down exactly how their system works.
Now, the moment someone says you get paid just to own something, I know your alarm bells are ringing. Free money? Yeah, sounds exactly like a scam. And honestly, as a behavioral psychologist, I'll tell you, that skepticism, that is a pure survival instinct. Keep your guard up. But what if I told you this isn't some shady scheme? What if it's actually a deeply historical, incredibly mechanical system that wealth builders have been quietly using for literally centuries?
To understand why this matters, we have to look at the painful reality most of us are trapped in right now. You go to work, you trade your literal energy, your time, and your focus just to get a paycheck. And by the end of the month, you're completely exhausted, staring at your banking app, wondering where it all disappeared to. It is the ultimate hamster wheel. The psychological toll of this is absolutely massive because you are stuck in a 1-to-1 ratio, trading your precious, limited time for dollars. Watching other people somehow bypass this exact struggle, it just makes you feel like you're always one step behind.
So let's completely reframe how we look at income. We need to talk about dividends. Simply put, a dividend is just a share of profits paid out to shareholders. Think about it logically for a second. You park your money in a savings account, and the bank throws you a tiny, microscopic fraction of a percent of interest, right? So why wouldn't a massive, highly profitable company pay you something for letting them use your money to grow? Well, they do. They just call it a dividend instead of interest. And unlike your savings account, this is a legitimate wealth builder that can completely alter your financial trajectory.
Now, what's really interesting about this slide is the root psychological cause. Like, why would a company just hand you cash? Well, think of a young, scrappy startup. They are in pure survival mode. They have to plow every single dollar right back into the company just to stay alive. But a mature blue chip company, they've already won. They've conquered their market. They literally have more cash pouring in than they can aggressively invest. So the absolute most logical move for them is to share that excess wealth with people like you. Okay, let's break down the hard math so it actually clicks. Say you buy 100 shares of one of these mature companies at $50 a pop. That's a $5,000 investment. Then the company announces a quarterly dividend of $1 per share. Boom, you receive $100 every 3 months. That's $400 a year, which is an 8% return. And here's the absolute kicker. You didn't sell a single share to get that money. Your original $5,000 is still sitting right there. You literally just got paid rent for owning it. Now watch how this simple loop turns into compound growth on steroids through a dividend reinvestment program, or DRIP. This right here is what separates the people who just understand money from the people who actually build wealth. Instead of taking that $100 payout and buying dinner, you automatically use it to buy more shares. So next quarter, you have more shares, which means your next payment is bigger, which buys even more shares. It creates this incredible behavioral loop where your money is out there having babies, and then those babies are having babies. But you gotta realize, this requires a massive shift in mindset. It's the difference between planting an oak tree and picking flowers. Let's be real, dividend investing is a marathon, not a sprint. The companies paying the most reliable dividends, they're not the ones making flashy tech headlines. They're the boring ones. They make your toothpaste, they brew your morning coffee. Sure, the flowers look really pretty today if you're trying to get rich quick. But those boring, everyday companies, those are the oak trees. They provide financial shade for generations. All right, mid-explainer twist time. Here is an uncomfortable truth that completely freaks out new investors. Pay super close attention to this. In the days leading up to a dividend payment, a stock's price usually creeps up because people are piling in to get the cash. But on the exact day that dividend is paid out, the stock's price mathematically drops by the exact amount of the payout. So if they pay a $2 dividend, the stock drops by $2. So, wait, did you just lose money? Was it all a trap? I see new investors panic sell all the time because they think the market just manipulated them or something went terribly wrong. But guys, it's just basic math. Think about it. If a company hands out millions of dollars of their own cash to shareholders, the company is fundamentally worth that much less on paper. Complaining about this temporary drop is quite literally like complaining that your wallet feels lighter right after you took cash out to pay for lunch. Now, we need to protect you from a major trap. You might look at the market and see one company offering a massive 12% yield and another offering just 3%.
Human instinct absolutely screams at you to grab that 12%. But in the dividend world, a 12% yield isn't a hidden gem. It is usually a giant, blaring red flag. Often, that high number only exists because the stock price has crashed violently and the company is bleeding money. It's exactly like a desperately empty restaurant offering a 90% discount. You really have to ask yourself why they're so desperate to get you in the door.
So where's the sweet spot? How do we find the safe bets? We look at something called the payout ratio. This simply tells you what percentage of a company's profits are actually going toward those dividends. If a company is paying out 90% of its profits, they are literally one bad quarter away from cutting your dividend to zero. The psychological sweet spot is usually between 30 and 60%. Companies in this range are kind of like a generous friend. They love picking up the dinner tab, but they aren't stupid enough to bankrupt themselves doing it. They share the wealth, but keep enough cash to actually survive. And speaking of keeping your cash, let's briefly demystify the taxes here, because there is a huge behavioral incentive built right into the system. If you treat stocks like a casino, buying and selling constantly, the government taxes your dividends at your normal high income tax rate. But if you commit to holding the stock for more than 60 days before the payout, Uncle Sam actively rewards you with a much lower tax rate. The whole system is literally designed by the government to financially reward patience and strictly punish impulsivity.
Now, if you're sitting there wondering, does this strategy actually hold up when the world falls apart? Let me introduce you to the dividend aristocrats. These are massive companies that haven't just paid dividends. They have actually increased their checks every single year for over 25 years. We're talking through the 1970s oil crises, the brutal 2008 market crash, and the 2020 pandemic. While everyone else was completely panicking, these companies just kept sending bigger checks. That is the definition of resilience.
So, what does this all mean for you? How do you actually apply this today and build your own avalanche? First, avoid chasing those dangerous high-yield traps. Second, focus on steady, boring growth. And third, and honestly this is the best part, you don't even have to pick individual stocks. You can just buy dividend ETFs. Think of an ETF like buying one slice of every single pizza in the restaurant. Instead of gambling on whether the pepperoni or the supreme is going to be better, you just buy the whole shebang. The fund collects all the dividends from all those companies, bundles them up, and sends you your share. Easy. The traditional path tells you to work tirelessly for your money until you inevitably run out of time. But true wealth builders, they completely flip that script. They build systems, they plant oak trees. Don't just work for your money. Position your money so that it starts sending you quarterly thank you notes. If this explainer shifted how you view building wealth and you are finally ready to stop trading your precious time for every single dollar, make sure to hit subscribe. We've got a whole lot more systems to uncover together. Catch you next time.